always invest for the long term. He said this, the correct holding period for stock market investments is forever. If you are not willing to own a share for 10 years, then don't own it for 10 minutes. Contrast this kind of advice to the kind of advice you get from your friendly neighborhood stockbroker. Jason Zweig has a beautiful saying where he mixes equity and real estate. He gives you the real estate example. Let's read this, it's worth reading. If after checking the value of your stock portfolio at 1:24 p.m., you feel compelled to check it all over again at 1:37 p.m., ask yourself these questions. Did I call a real estate agent to check the market price of my house at 1:24 p.m.? Did I call back at 1:37 p.m., market value of your house? If I had, would the price have changed? If it did, would I have rushed to sell my house? By not checking or even knowing the market price of my house from minute to minute, do I prevent its value from rising over time? I give you that example of that college professor. 5,000 rupees, 7 lakh rupees, 34 years, 140 times. Did he keep checking this? The buy and hold is the oldest and best strategy. That's why you have this saying, stock market is a mechanism by which money is transferred from the impatient to the patient. That's why you have this. I bought a share, it went down. I held on, got fed up. I sold it yesterday, today it has flared up. 4 ways of investing in equity. You can invest in a well-diversified portfolio of blue chip stocks. You can invest in diversified equity funds, index funds, and until the tax benefit is there, the ELSS funds to save a little tax. You can use systematic investment plans to invest in diversified equity funds. And you can use a strategy called the systematic transfer plan, about which I'll tell you very shortly. These are the 4 simple and effective ways of investing in equity, whether directly or through mutual funds. The next point is that systematic investment is good for you. Anthony Gallia says this, investing is a strange business. It's the only one we know of where the more expensive the products get, the more customers want to buy them. Look at any shop on your main roads where it says 50% discount or buy one get one free. You'll always find a big crowd there. Why? I'm buying because I believe that I'm getting something for a lesser amount. But in the stock market, when the index is 8,000 in March 2009, everybody is unanimous that the market will come down to 5,000. Let it go up a little bit to 17 or 18,000. Now they're talking about 22,000, 25,000. And now brokers are coming trying to get you to invest, at least trade. Brokers are coming, invest accounts. Why? Because the market is high. Buying when it is high is one of the most stupid things an investor can do. Now, one way of getting out of this is to opt for systematic investment, and very few of us realize the power of systematic investment. Let me give you a very simple example to contrast between a lump sum one-time investment and a systematic investment. Let us say you're a stock market investor. You buy a stock quoting 100 rupees. The market price is 100 rupees. You believe the stock is good. You buy 100 shares. You have invested 10,000. To your misfortune, you have invested at the peak of the market, and before you know it, the price has dropped from 100 to 70. But you are not a speculator, you are a hardcore investor. Your argument is, if I found it attractive at 100, it's much more attractive at 70. So I'll buy another 100 shares, 7,000. Now the market goes into long recession, 2 years, 3 years. The price of the share ultimately comes to 40 rupees. A speculator would have exited at this in panic. But as an investor, you're getting the annual reports of the company. What you find is, yes, there's a general economic recession. Company is not doing well, but it is still earning some profits and paying some small dividends. Now your argument is different. If this company is at least managing to keep its neck above the water in the bad times, once again when the economy starts ticking, the share price will probably go up. So let me buy a last quantity of 100 shares. You end up with 300 shares at 21,000 rupees or 300 shares at an average price of 70 rupees per share. Now this, let us compare with systematic investment. In normal investment, we get fixated by quantities. Buy 100, sell 500, buy 250 quantities. Systematic investment, the focus shifts to equated monthly installments. Not a number of shares. It is amount. Is it 3,000? Is it 5,000? Is it 10,000? Here we have invested a total of 21,000 rupees in 3 installments. 21,000 rupees divided by your 3 installments is 7,000 per installment. The only difference in focus is from lump sum or number of shares to equated amounts. Rest of the example is same. You make your first purchase when the market price is 100, you buy 70 stocks. You make your second purchase when the market price is 70, you buy 100 stocks. You make your third purchase when the market price is 40, you buy 175 stocks. Now if you total, you are in for a bit of a surprise. You have bought 345 stocks, not 300. And your average looks a little different. You are not even aware of these things. The beauty of systematic investment is automatically, without your knowing it, you are buying less number of units when the market is up, greater number of units when the market is down, automatically. So you always end up with an average price that is lower than the simple average. It's more of a weighted average. This is one of the most powerful tools in the hands of a normal investor. Systematic investment automatically enables right pricing. Most importantly, just like we are very good at cultivating bad habits, we can also cultivate good habits. Systematic investing is one of the finest good habits we can cultivate. And that old saying which I really believe in, if you work on an investment, it will work for you. You work on it now, one day it will give you the returns. The ultimate objective of good investing is to obtain above average returns at below average risk. I come back to an earlier point I made, optimum returns. Those who strive for optimum returns will get returns slightly higher than the optimum. I have seen this almost unfailingly. This is all you have to do. Don't aim for the top. There is an average return, let me go slightly above it. There's an average risk, let me go slightly below it. And one way of achieving this is through the systematic investment route. Very few of us know the kind of tremendous control we have over risk. Everybody talks about risk. The risk is in ourselves. In fact, Jason Zweig, whom I quote, he has a beautiful quotation. He says, you want to know what risk is? Go to your bathroom and look in the mirror. That is risk. What you see in the bathroom mirror is risk. That is, the risk is with us, not with the stock market. Let me give you one simple example how you can control risk. Warren Buffett says his definition of risk is totally different from what you will find in any textbook. Risk comes from not knowing what you are doing. There is such a huge sea of investors. Moment you tell them stock market is good, they say, but it is risky, but it is risky. So many years back, this thing was constantly coming back to me. There is such a large number of investors who want to invest in the stock market, but who do not want the risk in the stock market. Is there a way of investing in the stock market without taking risk? There is. You will be shocked to know there is. I'll give you a very simple. You can check this out from any websites or others. Do your own research. Invest 1 lakh rupees in one of these 3 mutual funds. Liquid, short-term floating, or short-term mutual fund. Any one of these. Register what is called an STP, Systematic Transfer Plan, of 1% per month, 1,000 rupees per month, to any diversified equity fund. But if you want to follow is on my advice, any fund that tracks the NSE 50, or as we expand, maybe the NSE 500. That should be more than enough. 1% per month. There will be no risk to capital at any point of time, regardless of stock market conditions.